proud FinTrammer who's been teaching students across the globe and across designations, and I welcome you all to this session where we will be revising through the key concepts of the Advanced Performance Management paper. So, when we talk about the revision part, we're going to be doing it in a really old school style, okay folks? So I have my notes over here, right, as you can see, right? So I'll be writing down each of these topics one by one, and I would highly suggest that you would do the same as well. Just have a piece of paper or a notebook in front of you so that you can write down the same things. And the more you write, the better you remember, as some advertisements said in the olden days, right? So that's basically the idea, okay folks? So just go ahead and let's just revise through each of these key concepts one by one and then be prepared for the exam. Okay, folks? So let's get started. Let's get started with the first topic, shall we? Costing, right? So what exactly is costing all about? Costing is basically the process of determining the cost of our product so that eventually you can use this to determine the selling price of the product as well, right? And of course, there are many other purposes as well. And when it comes to costing, we've learned about several methods of costing, right? So what all methods have we covered? Let's have a look. First of all, there is the traditional method of costing, which is absorption costing. There's of course marginal costing as well, which is kind of similar, but only considers the variable aspect, right? So that's also something to remember, I would say. And then we also looked at ABC, right? Activity-based costing. We've learned about target costing as well. We've looked at life cycle costing. And finally, we also had a look at environmental management accounting as well, right? So all of these concepts, let's quickly go through this once again, shall we? So when it comes to absorption costing, it's the traditional method of costing, as we know, right? And what is it used for? Basically to absorb the overheads, right? What are overheads again? Basically the indirect costs, right? Because if you are manufacturing a particular product, there would be direct cost as well as indirect costs. And direct costs are directly attributable to each of the products that I'm manufacturing, right? But whereas indirect costs, such as let's say factory rent, for example, right? That cannot be directly be attributable to each of the products, right? So what we do is we use several methods like absorption and ABC to allocate this cost to each of the products, right? That's exactly what we will be looking at again. So when it comes to absorption costing, we are dealing with allocating overheads, right? And how are overheads allocated? By calculating the OAR, overhead absorption rate, right? Simple as that. And how is overhead absorption rate calculated? With the equation total overheads divided by budgeted activity. Okay folks, so that's basically how we calculate the overhead absorption rate. Now within absorption costing, we are considering the total overheads overall, right? And then we're absorbing it based on a general basis, which is either machine hours or labor hours, right? This is basically what it would be in the exam. Okay, but when it comes to activity-based costing, now this is a bit more modern approach, right? And it's a bit more accurate approach as compared to the traditional approach of absorption costing. Okay, folks. So in activity-based costing, again we are absorbing overheads, right? But what's the difference here? Over here we are focusing on the cost drivers, right? We create cost pools and then identify the cost drivers or the driving factor of each cost within our organization. Okay, and then what we do is we calculate the OAR for each cost pool based on the cost driver. Okay folks, so this is basically what we do. Simple as that, right? Now, moving on. So that's it basically as to what activity-based costing is all about. And we use this ABC approach in many other concepts down the line as well, right? Like there's activity-based management, right? And activity-based budgeting, right? So we will look into that. And another costing method that we've learned was target costing, right? So within target costing, what do we do? Well, it's a step-by-step process, right? First of all, we determine the sales volume, right? How much products are we planning to sell? We determine that, right? And after that, we determine the selling price. What should be my selling price of my particular product, right? And then I determine the desired profit margin, right? And after determining the profit margin, what do? I calculate the target cost. What's the equation for that? Selling price minus profit margin, right? Simple as that. Okay, folks. And then, after that, what I do is I calculate the estimated cost. And after which, I calculate the cost gap. And what is the cost gap? Cost gap is basically the target cost minus estimated cost, right? And the overall idea behind target costing is to reduce the cost gap, right? Simple as that. Okay, folks, so that's basically the idea. And then we also looked at life cycle costing as well. So life cycle costing looks at the overall life cycle of a particular product and then calculates the overall cost. Simple as that, right? So, what all stages are there within the life cycle of a particular product? Well, we have, first of all, the development stage, right? Within the development stage, we conduct research and development, basically, and it's all, expenses. There is no revenue or income as such, right? And after development, we move on to introduction, right? In the introduction phase, we're just, introducing the product to the market, right? There's heavy, advertising and other expenses and everything, right? But, income hasn't yet started to come in, okay, folks? So we are making sales, yes. However, profits are not made yet, right? And after introduction, we enter into the growth phase, right? And within the growth phase is where we would, reach break even and start making profits, okay, folks? And eventually, we will enter the maturity phase, right? The maturity phase is basically the peak point, right? This is the maximum sales which we can achieve, or the maximum profits that we can achieve would be in the maturity phase itself. And at a later stage of the maturity phase, things would start to decline, right? The sales would start to decline and the profits would also start to decline, thus entering into the decline stage. Okay, folks, so these are the 5 stages within the life cycle of a particular product. Simple as that. Now, moving on to the next aspect. Environmental management accounting. So what all things have we learned over here exactly? Well, there are quite a few things, right? So let's have a look. For this, we may have to go to the next page. One second. Yeah. So, when it comes to environmental management accounting, there are 4 methods which we've learned here, right? What are the 4 methods? First of all, there was input, output analysis, right? And then there was flow cost accounting. We also learned about environmental activity based costing, EABC, right? And then we also looked at environmental life cycle costing as well. Okay, folks, so what is the idea behind all of these approaches? For input output analysis, what's the idea? Now, for input output analysis, the overall idea is this. It is based on the concept: what goes in comes out, right? So if we are inputting, let's say 100% of input, then that 100% should come out as output as well, right? So that's exactly the idea behind input-output analysis. But when it comes to a practical, manufacturing scenario, like let's say that we are inputting, let's say how does the process work? It's basically input and then process and then output, right? So when it comes to a practical sense, what's going to happen is I may input 100%, right? However, the output may only be 80%. Why is that? Because another 20% would be wastage, right? Okay, folks, so that's basically the idea. I'll just rewrite this. There we go. Okay, folks, so that's basically the overall idea behind input-output analysis. Okay, folks, we may input, it's an analysis where we assess the total amount of input which has been put into the system and how much of it has been processed out. Okay, folks, so if we measure that, we will be able to identify how much wastage was there and maybe try to minimize it down the line, right? That's basically the overall idea behind this particular method. Now, moving on to flow cost accounting. So when it comes to flow cost accounting, what's the idea? Over here, we basically categorize the material flow into three categories. Okay, folks, so first of all, there would be material, right? Which is basically the raw materials and everything, right? And then there would be system. And finally, there would be delivery and disposal. So the idea here is that under each of these categories, there can be positive or negative outputs. Now, what are these positive or negative outputs all about? Well, basically, the positive output are the good output that comes out of that particular category. Okay, folks, so that's basically the idea. And the negative is basically, again, the wastage, right? So under each of these category, material, systems, which is the handling of the materials and everything, and then delivery and disposal, there would be certain positive outputs as well as some negative outputs as well, right? So by conducting an analysis of both these aspects, we will be able to minimize the wastage. Okay, folks, so that's basically the idea, right, behind flow cost accounting. And then we also have activity-based costing environmentally, right, which is environmental activity-based costing, which is where we implement the ABC principles when it comes to environmental accounting. That's basically the idea here. Okay, folks, so we identify environmental costs and the driving factors that generate these costs. Okay, folks, that's basically as to what environmental activity-based costing is all about, right? I'll just write it down for you as well. One second. Cost drivers for environmental costs. And then when it comes to environmental life cycle costing, what's the idea here? We look at, again, environmental costs over the life of the product. Okay, folks, this is what we look at in environmental life cycle costing. Okay, folks, so that's basically the overall idea behind environmental management accounting as well. Okay, folks, so that's exactly the entire, costing related topics. Now let's have a look at the other topic, shall we? So the next topic that we will be covering is basically in relation to strategy and planning. Okay, folks, so what exactly is strategy? But before that, we need to understand the process, as in why exactly or how exactly does the overall process is the overall process conducted, isn't it? So let's just let me just write it down for you. First of all, every organization, okay, folks, and I mean every business organization would have certain objectives, right? And we call it the corporate objectives. In order to achieve these corporate objectives, we have to take a course of action, right? And this course of action is known as strategy. Now, the next aspect. When it comes to strategies, right, there are several ways in which we can implement one. Okay, folks, and that's basically what we've learned, as in it's basically a process. Okay, folks, so there's a 3-step process in implementing a particular strategy, and my first step would be to conduct a strategic analysis. Right, we have to conduct a strategic analysis, and after that we have to make a choice, strategic choice, and finally we have to implement it. So strategy, implementation. So under strategic analysis, we assess the overall environment of the business, right, through various models and various tactics, right, and obtain an understanding of that particular business environment, right. This is what we do in strategic analysis. And then we identify various courses of action which we can use to eventually achieve our corporate objective, right. This is basically what happens when it comes to strategic analysis. Now, after choosing those courses of actions, or after identifying those courses of action, we have to choose the best one. Okay, folks, out of the several courses of action that are there, what is the best course of action which we can choose, right? We do that. And then finally, what do? We implement it, right? We implement that particular course of action as well within the organization. Okay, folks, so this is the step-by-step process through which we are implementing that particular strategy in an organization. Analysis, choice, and then implementation. Simple as that. Now, moving on to the next part, there are 2 more terms which are really important, right? Which is planning and controlling. So what is planning and controlling all about? Planning is all about, as the name suggests, planning things in advance so that all the operations and all the activities can be conducted in the most efficient and effective manner. Simple as that. And controlling is basically comparing the planned activities with the actual activities and identifying deviations and then, investigating into them, right? Or taking corrective actions to reduce those deviations, right? So that's exactly what these 2 terms means. Okay, folks, to put it very simply. And another aspect which we have to look at is basically the difference between 2 terms needs to be assessed, right? I'll just go to another page. There we go. We also have to talk about the 2 terms, performance measurement, and then there is performance management as well. Okay, so what's the difference between these 2 terms exactly? So guys, performance management is the ongoing process of managing the performance of the organization to achieve its corporate objectives. Okay, folks, so that's basically the overall idea there. Whereas performance measurement is measuring the extent to which we have achieved those objectives. So one is managing performance, to put it very simply, right, in the most simple sense. And the other is all about measuring the extent to which the objectives are achieved, isn't it? This is the difference between both these terms. And in your exam, okay, folks, there can be certain requirements where you may have to talk about how a particular system implementation or a particular event can impact the performance measurement and performance management of the organization. Okay, folks. So when you're talking about performance measurement, you have to talk about the ratios, you have to talk about the measures that are there for that organization in your particular exam question, right? Talk about that, right? But when it comes to performance management, you can talk about, how the people within that organization is managing the overall performance of that organization, and the day-to-day activities, how are they conducted, and all these things. Okay, folks, that's the difference between both these terms. Simple as that. So yeah, other than that, of course, there are also several models which we have to learn as well. So let's have a look at that, shall we? So, folks, when we look at certain models, or for the models that we have learned throughout our session, right, there are a few things that you have to keep in mind. That, whenever you are learning about a model, you have to understand the objective of that model first. Okay, folks. So, the first model that I'm going to talk about is basically the SAF model. Okay, folks. And what is the objective of this particular model? It would basically be to help in choosing the right strategy, right? It helps us to choose the right strategy, right? So within the SAF model, we look at three things majorly, right? What are the three things? Suitability, right? Is the particular model actually suitable for the organization, right? And then we look at the accessibility, right? Hold on a second. Yeah, sorry, acceptability, right? My bad. Acceptability. And then we also look at the feasibility as well, right? Okay, folks, so suitability, acceptability, and feasibility. What is suitability all about? Like, does it actually suit the organization? Is it in line with the objectives, right? Those are the kinds of things that we're looking at. Is it in line with the, let me just make this smaller. There we go. Yeah. Corporate objective, right? That's basically what we look at in suitability. And what about for acceptability? Is it acceptable by the stakeholders, right? This is basically what acceptability is all about, right? And then finally we have feasibility, which is simply the question: is it feasible? Well, that kind of sounds kind of obvious, right? So let me just rephrase that or into something like: do we have the resources to implement the strategy? So these are the questions that you need to ask yourself if you are implementing the SAF model in the exam. Okay, folks. So is it, first of all, in line with our corporate objective? That's what suitability is all about, right? And is it acceptable by the stakeholders? That's what acceptability is. And then do we have the resources to implement that particular strategy? That's what feasibility looks at. Okay, folks. So if all three of these criteria are met, then we can say that that particular strategy can help us in achieving our overall corporate objectives. Okay, folks, and it can help us choose the best one, right? That's basically as to what we use the SAF model for. Now, moving on, I'll just clear this. Let's have a look at another model, which is basically the PEST model, isn't it? PEST model. And what is the objective of this particular model? It helps to conduct an environmental analysis, right? Because PEST model is usually used in order to conduct a macroeconomic environmental analysis. Okay, folks, so that's basically as to what we use this model for, simply. And what does PEST stand for exactly? PEST. There can also be E and L as well, right? So P stands for political, right? political aspects of the environment is looked at, right? Under political aspects, what all things can come over there. So when it comes to political aspect, it's in relation to the overall political stability of the governments and stuff like that, right? And if there are any other governmental policies, such as let's say taxation policies or something like that, which impacts the business, we look into that, right? And then E is basically for the economical aspects, such as the monetary policy, the interest rates, the foreign exchange fluctuation rates, right? All these things come under economical. And then there's the social. How is the community, how is the people or other stakeholders of that particular business impacting the overall organization, right? That's basically what social is all about. T is for technology or technological, right? So when it comes to the technological aspects, be it for the manufacturing process, be it innovation in the product, be it any other disruptive technologies as well, like how is it impacting the business, right? This is what we are looking at over here. And then the next E, or the optional E and L, stands for environmental, such as things such as sustainability and all these things, right? That comes under over here. And then legislative. Is there any change in laws or anything that impacts the business, right? All of these things are what comes under this particular model, or this particular factor, I would say. So we look at all of these factors one by one and conduct an analysis to see, like, is there any change or any event that has caused an impact on the organization, right? This is how we conduct the environmental analysis using PEST model. Simple as that. Now, what else? What other model have we learned? There's also the SWOT model as well, right? I'll just erase all this. One second. So what is the SWOT model all about? Here we look at 4 factors. What are the 4 factors? Again, this is also for environmental analysis. Let me just write that down. So when it comes to SWOT, there are 4 factors which we look at: S, W, O, and T, right? S is for the strengths, W is for weakness, O is for opportunity, and then T is for threats. So what's the idea here? First of all, these 2 factors are internal, whereas these 2 are externally focused, right? So this is basically the overall idea behind SWOT analysis, right? Internally, we focus on our strengths and weaknesses, and externally, we look at what all opportunities do we have in the environment, and what all threats do we have which can cause a risk for our organization, right? These are the things that we look at under SWOT analysis, to put it very simply. Okay, folks, so that's basically as to what this particular model is all about. And what other models have we learned about? We've also looked at the Porter's 5 force model, right? Let me just clear all this. So what is the objective, or why do we use this particular model for? To analyze the competitive environment of a business. Okay, folks. So when it comes to Porter's 5 force model, there are 5 factors, according to Porter, there are 5 factors that influences the competitive advantage that an organization has in a particular, segment, market. Okay, folks, so segment, market, or industry. Okay, folks, so that's basically the idea. So what are these 5 factors? First of all, there is, of course, competitive rivalry. right? And then there is threat of new substitutes. One second. And then there is threat of new entrants. Then there is bargaining power of suppliers and bargaining power of customers as well, right? These are the 5 factors which would impact the overall competitive advantage that an organization has in a particular market or industry, right? So that's exactly it. Okay, folks, that's exactly as to why we use this particular model 4. So remember this, right? And there's also another model provided by Porter itself. So what was that particular model again? It is basically the Porter's diamond, isn't it? I'll just write it down for you. Porter's diamond. So within Porter's diamond, there are 4 factors. Okay, folks, 4 factors that can determine the competitive environment of a nation. Okay, folks, so we're looking at a competitive environment within a particular nation, and Porter says that there are 4 factors which can influence the competitive advantage that an organization have within a particular nation or industry. Okay, folks, what are these 4 factors? First of all, there are factor conditions, right? Factor conditions, and then there are related or support activities, and then there is factor condition. There is firm strategy, right? And then demand conditions as well. All right, so these are the 4 factors which can influence the competitive advantage that an organization has within a particular nation. And why do we call it a diamond exactly? Well, you'll understand that when we draw the line, isn't it? Simple as that. Okay, folks. Okay, folks, that's basically why it's called a diamond, simply. So, any which way, so what are these factors one by one? Let's quickly discuss through that. Factor conditions, basically the conditions of the factors of production, such as land, labor, capital, all these things. Okay, folks. And then demand conditions, what exactly are the customers' taste and preferences and stuff like that. Firm strategy, what is the strategy that the organizations are planning to implement in relation to prices and in relation to other market conditions and stuff like that, right? And then there is related and support activities, like how good are the related supporting activities. For example, if I am manufacturing, let's say computers, right? Then there would be certain suppliers, like people who provide chips and stuff like that, right? So like chips to like motherboards and stuff like that, right? So are those suppliers and everyone also or will they be able to support that particular industry, or will they be able to provide goods on time? All these things are dependent factors as well, right? That's exactly what the Porter's diamond talks about. Okay, folks, so these are the 4 factors that can enable an organization to have a competitive advantage in a particular nation. Okay, folks, that's basically the idea. Now, what else? Any other models that we've learned? We've learned many, right, throughout our sessions, right, in detail, going one by one, right? So I'll just quickly revise some more of those as well. Let me just clear all this. Clearing seems fun, right? But writing isn't, right? So yeah, okay. Another model which we've learned was the BCG matrix, right? What do we use the BCG matrix for? To analyze the portfolio investments. Out of all the projects and investments that we have, what we do is we categorize these into 4 categories, right? What are the 4 categories as per the BCG matrix? Not straight line. Okay, there we go. There would be star investments. There would be problem child. There would be cash cows and dog investments as well, right? So all of these factors are dependent on 2 factors. Okay, folks? What are the 2 factors that we look at when it comes to the BCG matrix? We basically look at the market growth, or to be more specific, the relative market growth, and then the relative market share, right? Okay, folks. So by looking at the relative market growth and relative market share, I'm categorizing my portfolio of investments into 4 categories. There's the star investment, which is high market share and high market growth, right? Then there's the problem child, which is low market share, but it has high growth opportunities, right? We also call it a question mark as well, right? And then, we also, have cash cows, which can generate cash since it has a high market share and everything, but there are no growth opportunities for this particular investment, isn't it? So, we may still keep it since it's generating cash, but there are no growth opportunities, so we won't invest more as such. And then there are dog investments where there is no market share or low market share and, lower growth opportunities as well. For these kinds of investment, we usually just, ignore it or like divest it. But if we see any opportunity, then it can come under any of the other categories as well. Okay, folks. So yeah, ideally there should be more star investments or problem childs for that matter, because it has more growth opportunities down the line, right? So it will provide us with sustainable returns, right? That's basically the overall idea behind BCG matrix. This is how you categorize the portfolios using BCG matrix. Simple as that. Now, moving on to another aspect. Throughout our sessions, we also looked at another strategy, right? What was that? We also looked at Porter's generic strategies as well, isn't it? What were Porter's generic strategies exactly? First of all, there was cost leadership. That was definitely there, right? Then there was differentiation. And thirdly, there was focus differentiation. So what are these 3 things? Cost leadership is the idea that within my market, I can gain competitive advantage by selling my product at the lowest cost possible, right? So that's basically how we achieve cost leadership. Just minimize the cost to the extent at which we can provide the overall selling price at a reasonable price, right? That's basically the idea. And lower than our competitors so that, more customers are attracted to us, right? That's basically the idea. And then we have differentiation. What's the idea behind differentiation? Bring something innovative to that particular product, right? That's basically as to what differentiation is all about. And focus differentiation is kind of the same thing. It is bringing something innovative or something like a new feature or an add-on feature or something like that, right? But in focus differentiation, we are focusing on a smaller market size. Okay, folks, not a general product, it's not in relation to a general product or anything like that, like in differentiation. Focus differentiation is focused on a very small market, and it's basically for startups and other organizations such as that. But down the line, as businesses grow, it'll take up cost leadership or differentiation strategies. Okay, folks, so that's basically how it usually works. Simple as that. So these are the generic strategies that Porter has. Now, So that's basically all about this one. Another point that we will be covering would be regarding the CSFs and KPIs. Okay, folks. So every organization would have their objectives or mission, I would say, right? So in order to achieve these objectives or mission, what do we need to do? What we have to do is we have to identify something known as critical success factors, or as we call it, CSFs, right? So we have to identify the critical areas where we have to excel at in order to achieve these objectives. That's what CSFs are, right? And in order to identify the extent to which we have excelled in each of these CSFs, what do we have? We have key performance indicators, or KPIs as we call it, right? So we have key performance indicators to ensure that or to measure that, or to measure the extent to which we have excelled in each of the CSFs which we have identified for our organization. Okay, folks? So that's basically the overall idea. For example, let's say that if I'm taking a company like, let's say, Swiggy or Zomato for that matter, right? Like there are several aspects, several critical areas which is relevant for that business to succeed, right? For example, on-time deliveries, right? That's an area where deliveries is basically an area where they have to excel at, right? Customer services is an area where they have to excel at. Good quality food is an area which is relevant to them, right? So for each of these areas, what will they do? They'll set up certain measures, such as number of on-time deliveries done, or maybe number of customer complaints successfully managed, right? Or average waiting times for customers to call an agent, or all these things. Okay, folks. So all these measures are there to measure the extent to which they have excelled in several critical areas. Okay, folks. So that's basically the idea behind KPIs and CSFs, to put it very simply. Now, another point which we have to cover is basically in relation to the aspect of benchmarking. This is a really important topic, right? So what is benchmarking all about? So let's talk about benchmarking. What is benchmarking all about? Benchmarking is an exercise where you compare your organization's performance with the best in class and see like what the gap is, right? That's basically as to what the activity is all about. Now, there are a few step-by-step methods which we can do this. I'll just write it down for you. What is step one? Step one would be to identify the objectives and critical areas. Okay, folks, that's the first step, isn't it? We have to set the objective of the organization and the critical areas where we have to excel in, right? And after that, what is step two? Step two would be somewhat easy to understand now, right? It is basically to identify the KPIs. If we have set the objectives and identified the critical success factors, then obviously it would be, the next step would be to just simply calculate or simply determine the KPIs of that particular CSFs, right? That's basically it. Okay, folks. And then the third step is basically to identify the benchmark. Right? Identify the benchmark or the best in class within your industry. And number four, what would number four be? Number four would be the measurement of performance. Okay, folks, you have to measure the performance of our organization and then compare it with the benchmark. Okay, folks, these are the 5 steps. And then, of course, the 6th step, I'll just write it over here, would be to identify the improvements right? And then what? You have to implement and monitor the improvements. Okay, folks, so these are basically the step-by-step process, isn't it? First of all, you identify the objectives of the organization and the CSS, right? And then you set KPIs, and then you identify a benchmark against which you can compare this particular KPIs with, right? Measure our performance, compare it with the benchmark, and of course, obviously, there would be some gaps, right? So we have to assess the gaps and then identify the improvements which we can implement in our organization to be on par with that particular competitor or the benchmark, right? And finally, we have to implement those improvements and continuously monitor performance again to ensure that we are going in the right track and down the line we will be the benchmark, right? So that's exactly the overall benchmarking exercise. Okay, folks, so it's a very important concept, I would say, because there could be certain measures and stuff like that which can be tested in the exam, right? So just be mindful of this. Okay, folks, so yeah, that's basically it. That's basically all about benchmarking. Now, moving on to another topic. So, another topic which we could discuss is basically, again, a really key topic, which is basically budgeting. Okay, folks? Let's talk about budgeting. So, what is budgeting all about? Setting targets so that we can, have certain control of ourselves regarding the activities that we do in an organization, right? That's basically the overall idea behind budgeting. And when we talk about budgeting, there are several methods of budgeting which we looked at, right? And that's very important when it comes to the exam. And if you're lucky, this is like one of the easiest questions that can come up as well. Okay, folks, so what are the types of budgets? There is obviously the traditional method, which is incremental budgeting, right? And then there is zero-based budgeting. And then there is activity-based budgeting, or I'll just simply write ABC budget or ABB. What else? Rolling budgets. And there is, of course, beyond budgeting as well, right? Alright, so folks, let's talk about each of these budgeting methods one by one, shall we? So for incremental budgets, this is more suited for those organizations that have a stable environment. Okay, folks? So if your organization has a stable environment, then incremental budgeting would be very suitable for it, right? And does it have any plus points as in advantages? Most definitely yes, right? It's quick and easy, right, to do, right? But because what are we doing in incremental budgets? In order to create, let's say, the next year's budget, what I'm going to do is I'm going to take the current year actual results, make some adjustments, and then carry it forward to the next year. Okay, folks? So the adjustments would be in relation to inflation and other, economical factors such as that. Okay, folks? So that's what incremental budgeting is all about, to put it very simply, right? And, one of the key disadvantages is that you are carry forwarding the inefficiencies as well, right? You're carry forwarding the inefficiencies when it comes to incremental budgeting. It is quick and easy, yes. It is the traditional approach as well, but it's just that you'll be carry forwarding all the inefficiencies that has happened in the current year as well. Okay, folks, that's one of the demerits. Now, what about zero-based budgets? Zero-based budgets are more suitable for those organizations that operate project-based businesses. Okay, folks, when they are project-based. What are project-based businesses? Basically, when they have multiple investments and multiple investment decisions to make and stuff like that. Okay, folks, so that's basically the idea. So so the idea here is that it's time-consuming, right? It is a time-consuming process because when it comes to zero-based budgeting, we're starting every single thing from scratch, right? everything starts from scratch. We're not carry forwarding anything from previous year. So one of the advantages because of that would be that there won't be any inefficiencies carry forwarded. Okay, folks, no carry forwarding of inefficiencies. All right. And what else? It would be judgmental, right? Right? It would be judgmental. Why is that? Because, see guys, when it comes to zero-based budgeting, if you have to add anything to the budget, then it will be scrutinized by the management. Okay, folks, they will have to first of all assess whether there is a need to add that particular item to the budget. They will be creating decision packages. They'll be ranking decision packages. So basically, as I mentioned before, it's a time-consuming process. It needs a huge requirement of manager time, right? And they'll have to exert a greater degree of judgment to decide what needs to be in the budget and what needs to be removed. Okay, folks, so that's basically the idea here. So that's what zero-based budgets are all about. Okay, folks, it is time-consuming and judgmental, but it does not carry forward any inefficiencies, and it ensures that only the appropriate things are added into our budgets. Okay, folks, so that's basically one of the greatest advantage of this type of budgeting. And what else? We also have ABB, right? Activity-based budgets as well. So in activity-based budgeting, we implement the ABC principles when it comes to budgeting. Simple as that. Okay, folks, again, what are the driving factors of costs and revenue is what we look at. Okay, folks, what are the driving factors of costs and revenue? Again, it's more suitable for complex organizations, right? And it has the same advantages and disadvantages as that of an ABC costing. Okay, folks. So when it comes to ABC costing, what are the issues exactly? There is an issue, isn't it? Because it's kind of difficult to identify just rewrite this here. The cost drivers. However, when it comes to complex organizations, it's kind of really difficult to get a hold of like where the costs are coming from and stuff like that. Okay, folks. So in that sense, for cost control purposes, ABB would be really suitable for these kinds of organizations. Okay, folks. So it helps in cost control as well. Okay, folks, that's the features of ABB, to put it very simply. And then we have rolling budgets, right? So what's the idea behind rolling budgets? These budgets are continuously updated, right? So this is dynamic in nature, isn't it? So it's more suitable for those organizations having a dynamic environment or an environment which keeps on changing. For example, something in the fashion industry or some organization in the let's say technological industry, right? So for these kinds of business environments, it's continuously updated and continuously changing, right? So for those organizations, having rolling budgets would be very appropriate. And what happens in a rolling budget exactly? So what we're going to do is, let's say that I'm standing on December, let's say 2024, right? So what I'm going to do is I'm going to plan the next 12 months worth of budget, right? Like I normally do, right? But after my first quarter, right, for the next year, as of now, I've already created a 12-month budget in December 2024, right? So in after the first quarter, which is March 2025, I'm gonna revise my budget based on the actual results from quarter one. Okay, folks, I will revise my budget for the next 12 months based on the actual result that has been received in my first quarter for in March 2025. Okay, folks. So from I'll just note it down for you as well, so that it'll be more easier to figure things out, right? So I'm standing on December 2020. Okay, I'll just draw a timeline. There we go. 2024, and I'll have multiple quarters, right? What are my quarters? My quarter one would be March 2025. Quarter 2 would be June 2025. Quarter 3 would be September 2025, and quarter 4 would be December 2025. Okay, folks. So, first of all, I'll be preparing my budget for the 12-month period over here, right? But once I reach this point, once I reach the end of quarter 1, what I'm going to do is I'm going to create an additional newly revised budget for till quarter 1 March 2026 based on the actual results during this quarter. Okay, folks, so that's basically how rolling budgets work. So keep this in mind, because there were questions tested historically, and there were many students who found a challenge in understanding this particular concept as well. So be mindful of that. Okay, folks. So yeah, going back to the budgeting aspect. So it's a dynamic budget suitable for dynamic organizations operating in a dynamic environment. So be mindful of that. And then are there any advantages? Most definitely yes. We will have realistic and up-to-date budgets. However, it is again time consuming, and managers may find it a bit demotivating to continuously update the budget again and again. Why? Because it's expensive as well, right? Okay, folks, so unless your business organization has a dynamic environment, we cannot implement this budget. Okay, folks, so then comes the concept of beyond budgeting. So let's have a look at as to what beyond budgeting is all about, shall we? So when it comes to beyond budgeting, it basically foils the idea of the traditional budgeting system. Okay, folks, why do I say that? Because let's have a look at the features of beyond budgets, shall we? F stands for freedom. Okay, folks, the freedom to, or basically providing autonomy to divisional heads and other managers to make their own decisions, because they have a bit more better understanding of the local conditions of their divisions and market, right? This is basically the idea. O stands for organization's focus. Okay, folks, organizational focus. We're just saying that the organization's focus should be on non-financial aspects as well, such as the customers, the quality of products that we deliver, and all these things. Okay, folks, that's another factor. I is for information systems, right? The IT and other information systems should be up to date and available so that we can make this beyond budgeting concept a success. And L basically stands for the long-term success. Okay, folks, our focus should be for the long-term success, because one of the other criticisms of budgeting is that it promotes short-termism, right? Because every financial year, people are trying to achieve a certain amount of revenue, a certain degree of cost, etc., right? And their mindset is constrained to a single year, right? But ideally, the organization, the people within the organization should be working towards the long-term success of the organization, right? Which is what beyond budgeting promotes. So we're saying that the traditional method of budgeting should be abandoned, and we should move towards beyond budgeting. Okay, folks, due to some criticisms that we have for budgets. What kind of criticisms do we have exactly? One is this, as in it promotes short-termism, right? Another criticism is basically the fact that we'll try to save the cost. Sorry, we won't try to save the cost, rather we would just control the cost. What does this mean? I'll give you a typical example. Okay, let's say that I'm setting a budget for material cost at $100,000. Now, as an employee, I would try to achieve this $100,000, and I'll make sure that my material costs do not exceed $100,000, right? This is what I do, right? As per budgeting, right? Because I'm given a target of $100,000, so I'll just stick to it. I won't exceed it, right? However, ideally, right, in an ideal scenario, shouldn't the employee think that, okay, my budget is $100,000, let's just try to save cost and bring it down to $80,000, This should be ideally be the mindset, right? Because ideally we should be minimizing cost, not controlling it, right? That's basically the idea. Okay, folks, that's basically one of the other criticism of budget. It doesn't save cost, but it controls it, right? So that's basically the idea. Okay, so so these are basically the concepts, really important concepts, which you have to remember in relation to budgets. If you have a question in relation to this, then it's a blessing because it's like one of the easiest questions that can come up. Okay, folks. So yeah, all right. So that's basically all about this. Now moving on to another topic. There are two more terms which you have to remember, and it's kind of important as well. We have business process re-engineering, and another term is business integration. So, what's the meaning behind both these terms? Business process reengineering, or BPR, is basically the radical rethinking or redesigning of the entire structure of the organization. Okay, folks, so as of now, let's say that I have certain processes, certain systems, and everything in place. So I'm changing everything completely. This is what business process re-engineering is all about. From one system, we're moving on to an entirely new process and set of systems. Okay, folks, so that's basically the idea. Now, why is this particular point really important? Because in your exam, they can give you a scenario where a company is implementing a new system or maybe a new process within an organization, and maybe some CEOs or some board of directors will ask you for your advice regarding this particular change as well. Okay, folks, so those kinds of questions can come up, which is why this particular term is really important to know. And just writing the definition of this particular term can give you at least 1 mark in the exam. Okay, folks, if it's asked, that is. Okay, folks, so yeah. And secondly, there is business integration. Okay, folks, so it's basically all about bringing together the processes or activities to ensure coordination. Okay, folks, so we're just bringing together certain activities so that things are more efficient and we can, ensure that everything is coordinated in an efficient manner. Okay, folks. So this is what business integration is all about. Okay, folks. So and again, why is it important? Because I'll give you a typical example here as well. Let's say that we're talking about let's say payroll and HR, right? Some of the activities between payroll and HR can be coordinated so that let's say that if a person joins the organization, then their records and everything are kept by HR, whereas all the payment details and everything, salary details, wages and details are uh, coordinated with the payroll system so that they can account for it and they can pay out the salaries and wages accordingly, right? So that's basically the idea, okay, folks. So it's all about integrating certain activities so that things can be more efficient and there's no wastage of time or money anywhere. That's basically the idea, okay, folks. So these are the another set of two terms which is really relevant for the exam. So yeah, all right. So that's basically all about this. I'll just move on to another topic. Now let's have a look at another model, shall we? We have the value chain model. And what's going to happen in the value chain model exactly? Like we have that figure, right? Okay. So within the value chain model, we have some primary activities as well as secondary activities, right? So what were the primary activities all about? Let's have a look. The primary activities involve inbound logistics, right? And then there is operations, of course. And then there is outbound logistics. What else? Marketing and sales. And then we also have, you know, after sales as well, right? After sales services as well. So these are basically the primary activities when it comes to an organization, especially a manufacturing organization, right? Because inbound logistics is all about the inputs that we receive, right? Operations is the processes that we do. Outbound logistics is basically the output that is generated, right? Marketing and sales would be, all about, the promotional activities that are conducted to promote our product, right? And the delivery aspects and everything, right? And then after sales services are the, this is basically services, installation services, as well as other sales and services that are conducted after making that particular sale, right? Simple as that. These are the primary activities of the organization. What about secondary activities? Secondary activities would include elements like, first of all, there's the firm structure, right? What is the overall structure of the firm, right? That needs to be looked into. And then what else? Other than that, there's the human resource management. What else? There would be infrastructure, of course. And then there would be, infrastructure comes under firm structure, right? So yeah, other than that, there would be procurement is the last item. And then there would be technology. Okay, folks, firm infrastructure or firm structure, human resource management, technology, as well as procurement. These are the secondary activities that are there. So firm structure is basically the overall structure of the organization, such as the infrastructure and everything, right? Human resource management, we already know the department that manages the people within the organization, right? Technologies, what all technologies do we use as an organization? The information systems, the IT and everything, right? And procurement, like how is the purchase activities and stuff like that conducted for capital investments and stuff like that, right? So this is basically the secondary activities that are conducted within a manufacturing organization. So what we would do is, we would, like, if you're determining, let's say, the selling price, right? So what you would do is you would just consider all the cost that is involved for each of these activities, right? And then add on a margin to determine the selling price, right? So what we're going to do is we're going to look at each of these activities, right? So what is the objective of the model? The objective is to promote value adding activities and eliminate non value adding activities. Okay, folks, so that's basically the objective of this particular model. We look into the primary activities and secondary activities, identify those values those activities which add value and those which do not, right? And then we eliminate the non-value adding and promote the value adding activities. Simple as that. Okay, folks. So this is what the value chain model is all about. And moving on to the next part, which is another model. We call it the McKenzie's, 1 second, 7S model, right? So we have the McKenzie's 7S model as well. So what is the McKenzie's 7S model all about? There are 7 S's, right, as the model suggested. So what are these 7 S's? Write an S over here. 2, 3, 4. I need 3 more, right? I need to mention 3 more. Where will I mention the other 3? Yeah, there is one in the middle. Then S, 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 S. There we go. Yeah. So when we look at the McKenzie's 7S model, right, there are there are some soft elements as well as some hard elements as well, right? So let's go by one. Like, what is the first S stand for? There would be structure. There would be system, staff, strategy, shared values, skills, and style, right? These are the 7S model, right? So all I have to do is I just have to connect these, of course. Like, each of these aspects are interconnected with each other, right? So that's exactly what the 7S model is all about. Okay, folks. So when it comes to the 7S model, as I mentioned before, like, we look at each of these 7 factors, and then we see where we can add value, where we can eliminate non-value adding activities, where we can promote efficiencies and everything. Okay, folks. So that's basically the overall idea. And ideally, all of these activities needs to be aligned with each other, right? Because if one of these factors is affected, then that will have an impact on all the other factors as well. Okay, folks, for example, if staff has, let's say, low motivation to work, then of course the skill will decline, because people will start leaving the organization, right? The values will be affected. Why? Because there will be new people coming in. They don't know much about the organization. They may not have they may bring forward certain values which is not in line with the organization's objectives, right? And the strategy can change. Systems would be impacted, right? So that's basically the idea. Okay, folks, each of these elements are interconnected with each other, and ideally all of these should be coordinated, and all of these factors needs to be coordinated together, okay, folks, for the organizational structure, so for the organization's success. That's basically the idea here. Okay, folks, so simple as that. So yeah, that's basically all about this particular aspect. Now, moving on to another concept. This is kind of similar. Sustainability. Okay, folks, so what is sustainability all about? Sustainability is the idea that whatever we're doing, right, our current activities should not be impacting or should not be harming the future generations. Okay, folks, so we need to meet our current needs without impacting or without harming the future generations. That's basically as to what sustainability is all about. And as part of sustainability, like, we learned about integrated reporting, right? What is integrated reporting all about? Within integrated reporting, we talk about 6 capitals. Okay, folks, so what are these 6 capitals? There is natural capital, there is manufactured capital, human capital, social capital, social and relationships as we call it, right? Financial capital. There's one more, isn't it? What is that? Intellectual capital, right? Okay, folks, so these are the 6 capitals that we have. So if you're preparing an integrated report, then you should speak about all of these 6 capitals, so that to demonstrate that the organization is an environmentally responsible, a socially responsible business, right? That's basically the overall idea here. Okay, folks, so what are each of these capitals? Let's go one by one. Natural capitals are basically, it basically involves the natural renewable resources and stuff like that which the organization utilizes for their day-to-day operations, right? And then manufactured capitals are the tools and machineries which are used for the manufacturing processes and stuff like that, right? Human capital, as we know, is the human resources, the staff, the employees, the managers, and all these people, the people that are there in the organization, right? Social capital is the relationships that we have, that the organization has with the community, or with the general public as a whole. Okay, folks. Financial capital, as we know, like it's all about the shares, the debt, the equity, and all these things, right? All the financial assets and liabilities that we have, all those things, right? And then intellectual capital relates to those things like the intellectual property. No, not exactly. Okay, folks. It's majorly all about the knowledge base that we have. Okay, folks, that's what majorly intellectual capital relates to. For example, the people within our organization will have a certain degree of knowledge, right? So, so that particular knowledge base, all the databases and stuff like that, right? So that's what comes under the intellectual capital here. Okay, folks. So that's basically as to what the 6 capitals under integrated reporting are. And if you are, publishing an integrated report, then we should be talking about how we are adding value under each of these capital to the general public, to the customers, and to everyone. Okay, folks, so that's basically the idea. Simple as that. Now, what else? Alright, folks, so let's have a look at another term here which is kind of familiar as well, since we've already discussed this particular topics multiple times throughout the syllabus, when we discuss that, right? So, and the term is basically CSR, right? Corporate social responsibility. Remember the examples which we discussed throughout the sessions, okay, folks? So yeah, keep that in mind. So CSR, right? So what is corporate social responsibility all about? This is basically the activities conducted by the organization in pursuit of having good relations with the community, with the general public, right? As a stepping stone for saving the environment, right? All these activities are considered to be a part of corporate social responsibility itself, right? And why do we say that? Because like the overall idea here is to promote the organization's reputation, right, by conducting activities that can promote relationship with the community, as well as take a step towards saving the environment as well. Okay, folks, so that's basically the idea here. And of course, like we also have to learn about another term known as empowering employees as well, right? Employees. So when it comes to empowering employees, like what are the things that we can do in order to empower our employees in the organization? Like I remember one of my students telling me this in our sessions, that we can maybe pay them more, right? So obviously that's the go-to thing, right? But other than that, like there are other non-financial incentives that can be there as well, such as having, let's say, recognitions and stuff like that, rewards and recognitions, right? And provide them with feedback on the work on a timely basis, right? And having clear communications of the organization's objectives and vision with the employees, so that the mindset is shared, right? So that's basically the idea that is mentioned over here. And what else? Is there any other methods that I can think of? Let's see. Let me just have a look at the notes as well once. Okay. Yeah, that's just it. Okay, folks. So that's basically right. I guess we covered everything. So whatever responsibility is given to a particular employee, right? We have to provide them with, clarity as well. Okay, folks. So that's basically the idea. Okay, folks. These are the things that are there. When it comes to the things that we can do for empowering the employees as well. So yeah, that's basically it. And another aspect that we have learned throughout is that as to how to handle the stakeholders of the organization as well, right? So when it comes to an organization, there are different multiple stakeholders that there are, right? The people who would have a certain interest in the organization. That's what stakeholders are, right? So which stakeholder should I prioritize? Because at times what happens is the objectives of different stakeholders can conflict with each other, right? So how exactly can we ensure that these or which stakeholders should be prioritized first of all? This is where another model comes in, which is known as the Mendelow's matrix. So how is the Mendelow's matrix used? We again have four quadrants, right? We have key players, we have keep informed, oh sorry, this quadrant would be satisfied, and then keep informed, and then minimal effort. And what exactly are the factors that we look into? We look at interest and then power, right? Interest and power are the two factors which we look into in order to categorize the stakeholders into one of these four categories. What are these four categories? First of all, we have minimal effort. Okay, so within minimal effort, like the interest and power of that particular stakeholder is low, therefore we may not have to take much effort towards that particular stakeholder. Okay, folks, so that's basically the idea. And then there's the keep informed category, which is where the interest is high, the interest of that particular stakeholder would be high. However, the power is low. They may not have much power over the organization, right? So that's that would basically be something like, for example, the company, the community in relation to the company, right? So the community can be said to be a stakeholder who may not have power, but they do have an interest in the organization, right? For employment opportunities and stuff like that, right? So that's exactly the idea here. And then there's the another category known as keep satisfied. And what's the idea here? The level of interest might be low, however, the power here is high. Okay, folks, such as the government, let's say, for example, right? The government may not have much interest in the organization unless, other than, the tax related aspects, right? But, they do have a greater degree of power over the organization, right? Since they are the ruling government, right? So obviously they need to be kept satisfied, pay taxes on time and everything, right? And then finally we have the key players, right? And these are the individuals who would have a high power as well as a high interest in the organization. Okay, folks, so these stakeholders are the key players and therefore we have to prioritize them above all else. Okay, folks, so that's basically the idea. So that's basically it. That's basically all about the Mendelow's matrix, right? And why do we use it for? What is the objective here? To prioritize the stakeholders, right? At times, certain stakeholders would have certain conflicting objectives, so therefore we will have to, prioritize some over the others. That's basically why, as in when we would, utilize this matrix. Now, moving on to the next part, we have organization, structure. So when we talk about the organizational structure, we learned about three types of organizational structures, isn't it? There is the functional structure, there is the divisional structure, and then there's the network structure as well, right? So let's talk about each of these structures one by one. What is the idea behind a functional structure? There would be a company X, right? And company X would have several departments, right? And each of these departments would be a certain process or function, right? It would be, let's say, accounting, there would be sales, there would be marketing, there would be HR, right? So like this, there are different departments which are focused on a certain function of the organization. This is what a functional structure would look like, right? Now moving on. And is there any advantage and disadvantages for a functional structure? Well, there are, of course, obviously, right? So what are the advantages? Well, we will have one particular function in one particular department, and our functional or divisional heads would be the head of each functions as well, right? So that's basically the idea, and they can coordinate the activities to a certain extent as well. So yeah, that's basically as to what the functional structure is all about. Simple as that. And when it comes to a divisional structure, what's the idea? Again, we have a company X, right? And then let's say that company X is involved in multiple products. Okay, folks, we have product A, product B, and then product C. Each of these products will have their separate departments. Okay, folks, of accounting, of HR, of sales, etc. Okay, folks, that's basically the overall idea. Alright, so this is how the divisional structure would look like. And again, this is also somewhat fine, right? The thing is that over here, compared to the functional structure, like within the functional structure, the primary decisions would be taken by the head office, right? So it's a centralized structure. However, when it comes to a divisional structure, it's a decentralized structure, as in the power or the decision-making power lies within the divisional heads of each of these departments, okay, folks, rather than the head office, which is company X. Okay, folks, so that's basically the overall idea here. And another common disadvantage of divisional structures would be the fact that there would be minimal, there would be duplication of work. Okay, folks. So since like we have an accounting department over here and over here as well, like each of these departments may generate the same information, which can create as in they may do the same work in different departments rather than coordinating with each other, right? So that's basically the idea that is over here. Okay, folks, so that's what another disadvantage of divisional structure is all about. Just gonna select all and then delete it again. 1 second. Alright. And then finally, we have the network structure. Okay, folks, there's no pictorial representation here because network structures doesn't really have to be physical, right? There's no need for a physical office or anything like that. It just has to be it can even be a virtual organization as well. Okay, folks, so we've seen many examples like modern businesses these days are starting off as virtual companies, and down the line they'll buy corporates and offices and stuff, right? So that's exactly what a network structure is all about. So their business model is primarily focused on contracts that they have with multiple other people. Okay, folks. So this would be suppliers, it would be delivery agents, etc. Okay, folks. So all of their or majority of their functions are usually contracted out or outsourced to other organizations. So they will have a list of contracts with for different functions. Okay, folks. For example, for HR, they may hire third-party organizations to hire people for them, and then there would be deliveries, let's say an online shopping platform like Amazon or Flipkart. They all started off within this particular structure itself, right? There wasn't any physical office, like they have a list of contracts with certain delivery agents, certain warehouse owners, etc. And down the line, as the business grows, there would be a need for physical offices and stuff like that. Okay, folks. So that's how a network structure operates. So yeah, that's basically it. That's basically all about this particular topic and this particular part of the revision series as well. I will see you later in the next revision series where we will be covering some more key topics of the Advanced Performance Management paper. Till then, this is Vishnu Vijay signing off.